Hi, I'm Keith McCullough. Welcome back. Hope you had a good weekend. This weekend is the long weekend in Canada, so happy Victoria Day to my Canadian friends. We have to work today in the U.S., so we're going to give you the macro market update from Mr. Macro himself, starting with number one, growth. There is no growth. Growth is slowing. So the Russell 2000 last week, down 0.4% on the week, down 5.2% for the year to date, down almost 9%. Since March. It has been painful for those who have been long growth. Yield spread, point number two, as bond yields and growth stocks fall, this thing called the yield spread, which is the 10-year yield minus the 2-year yield, continues to compress. Now, when the yield spread compresses, what you get is point number three, which is the financials underperform. So again, yield spread compressing is a great proxy for not only growth slowing, but the financials underperforming, because that's how the financials make money. It's called net interest margin. So if you basically squeeze them in that spread, that is not good for the financials. So the financials underperformed the Russell by a factor of 2 to 1 last week, which wasn't good to begin with. Now, the next question is going to be, well, if the Russell's underperforming and bond yields are falling and the yield spread is compressing, what is the causal factor that is slowing growth out there? I'll give you one wild guess. It's called inflation. Inflation accelerating. So let's just look at last week's inflation accelerating. In the face of really U.S. stocks, particularly growth stocks, having a problem, bond yields falling, oil prices were up a full 2.3% on the week. Now, not only is food prices up 22% on the CRB foodstuff basket year to date, but now oil prices are breaking out above what we call our tail risk line being on at the pump for your Memorial Day weekend. I hope you enjoy that. Now, after that, you get the barbecue going. Maybe you don't drive anywhere because you can't afford it anymore, but you fire up the barbecue and you put some meat on that thing, and that's inflating too. So if you look at cattle prices, up a full percent last week, up 13.5% for the year to date. In the U.S., meat prices are at all-time highs. All-time. All-time is a very long time for those of you who have been eating meat, and I think people have been eating meat for a long time. REITs, you can't eat those. Point number three, up 0.4% again versus the Russell, down 0.4%. REITs up 14.6% for the year to date. Just a fantastic year. So how do you like that? So again, whether it's your gas, it's your food, it's your rent, don't forget that a third of the country, President Obama, rents. Yeah, they do. They pay rent. A third of the country pays rent. Food and rent represent almost 40% of the average American's cost of living. So again, these things are inflating. You really need to tell Janet. You really should, because Janet is walking around telling everyone that there's no inflation, which is obviously kind of a bit of a lie. What is consensus on all this? I think most people out there, real common folks, understand that there is inflation. But the consensus on this is figuring it out. So if you look at futures and options positions in the S&P 500 in particular, what you could see here is that last week, the S&P 500 short position, including E-minis, went to 40,901 contracts. What that means is that people are putting on hedges. So again, that can be bullish in the immediate term because people have to cover, but at the same time, this is not where we were 6 months ago when this was really a net long position. Now, if you look at bonds and how people think about this concept of growth slowing in the bond market, this is the first week in 2014 where people would actually agree with that. In other words, it's the first net long position in terms of futures and options contracts in the bond market on the long end of the bond market. So again, that's in stark contrast to the last 6 months where you've had an average net short position of over 81,000 contracts in the bond market. So again, why is this? Because again, consensus still thinks that you have like 3 to 4% growth and that bond yields are going to go to 3.32% by the end of the year. That's consensus. Don't forget that the 10-year is at 2.5%. So again, consensus is wrong. It has to continue to adjust. That's why the style factors within the market, whether they be REITs versus growth stocks or cattle versus whatever you want to compare it to, it's all moving in and around these pylons that have become the U.S. stock market having a lot of constipation. So if you have any problems with the constipation or at that point, ping me at Keith McCullough is my Twitter handle.